Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Monday, April 14th, 2025. It's 12:26 p.m. Eastern Time as I'm starting the video, so we're about halfway through the trading day, and I just figured I'd get one out to you today. I kind of made my thoughts and my personal trading plan clear this morning, and I started with it last night, right around the same levels. It's irrelevant. We peaked out in the futures last night where we did today, and decided to just go ahead and book out all profits. So it's been a tremendous quarter, and especially recently very profitable, and it was a combination of both just instinct, gut feel. I've been doing this a long time. We were getting close to those downtrend lines, but I'll talk on that in this video as to why I didn't hold out for that final last little bit there. And we could still hit it, but let me go over the levels to watch, let you have the levels like always, formulate your own trading plan, and see where we go from here. So I'm going to start out with the equity markets. If I whip through them quickly, which knowing me, I probably won't. It'll probably go for a while. But if I do, I'll get to the other things out there that I'm watching. Like I mentioned, I still have positions in agricultural commodities. I'm speaking mainly to the trading account, but I'm also going to talk long-term stuff too in this video. I always do that. I'll let you know short-term, kind of what I'm doing in the active trading account, also long-term, so I'll speak to that as well. But let's start out looking at this. I'm gonna borrow this trend. I mean, take it and bend it a little bit down, move it down. That's where I had it on the futures this morning and in the 15-minute charts of QQQ, and I think that's what I shared with you. So that trend line's been taken out. That was an uptrend line off the low right here from the 8th. Is that the, April 8th low last Tuesday, and right before that big rip up. And this is a downtrend line I'm talking about. I won't recap what we've done. If you're new to the site, you can go back and check the recent videos. We've done a pretty damn good job of threading the needle down along this whole thing. Long, short, even with that preferred bounce target zone being hit, recycle back in. But more recently, I've been highlighting and focus on these 15-minute charts. Getting this out to you again. It's the same trend line I showed on the 60. You have a trend line that comes off that high from what is that, the 18th? No, I'll tell you what it is if you want to replicate it. The 19th, February 19th. And it is still something they're probably going to hit. And let me say this. I am completely open to the fact they could take this thing out, and if so, trigger another wave of buying. We could see. I'm open to anything. I mean, I always am to an extent, but I give you where I think things are going. I'm not going to sit here and tell you the market can go up, it can go down. If I do, I give you probabilities. I give you my preferred scenario, which one I think it's going to do. And most importantly, this is most importantly, instead of just saying, oh, we can go up or down, the levels in which, if taken out, will most likely trigger the next rally or the next correction. So that's what I do in these videos, and again, take it with your own analysis, with those of others. But this is the uptrend line right here. And so this is where we were. This is today right here. The open, we popped up. Told you in pre-market, made sure to get that one out early because that's when I started closing out positions. Futures were up a little even higher, I believe then, maybe about the same level. Either way. Why? Well, because for many reasons. But I think this trend line, and again, we're at resistance. I'm being repetitive here, beating a dead horse. The same resistance levels, the same preferred bounce target I was calling for before we even bottomed, calling for about a 16% rally in QQQ, which we got the other day, last Wednesday. That was a 16% rally. That was the time, obviously, to take profits. Expect to pull back then. We got a pullback. Expect another thrust up. But again, there's just a lot of, like I've talked about last week and repeatedly, a lot of what I call overhead supply. You got a lot of a lot of trapped longs that feel, a lot of them probably capitulated, but a lot didn't. I just know this from experience, both working as a former stockbroker and also doing this for a long time and getting feedback from others and reading what's going on out there. So I know there, some people threw in the towel to an extent, maybe fully. Everybody's different, guys. Of course, everybody's different. Some people may have puked up their whole portfolio, meaning sold all their longs. Others may have buried their head in the sand like an ostrich, waiting for it to end and praying and hoping on bended knee that it would recover. And then those folks, those are the ones we call a lot of overhead supply. Those are the ones that will have been and took advantage of selling a bounce going up. So what we do know definitively is the volatility is still high, so this is the norm. You get these up days, down days. Volatility is abating a little bit. You can see the VIX coming down, and instead of 6% days, we had several 6% days, even more intraday swings. This was the largest in, I think, 20-something years for the NASDAQ 100 right there, the largest single-day gain. And as I pointed out to you guys last week, and you can look up the headlines too from Wednesday's rally. The citations were the NASDAQ had its biggest day since 2000, I think it was, or around that period, 2000, 2001. The S&P 500 since 2008. And then they cited one other index, I forget what it was, since COVID, 2020, the COVID. And what those have in common, those were the three biggest and true bear markets that we've had in decades. And some of the people listen to this voice in your lifetime. And so the point being that is that the biggest single day gains almost always come in bear markets. So that kind of helps support the theory that's all this is, not a lasting bottom. We'll see. Time will tell. All right. So what we do know is we have a nice downtrend line overhead. This is significant resistance. And that little trend line was broken. But I'm just going to tell you what I think is going to happen today. I think that's a little false breakdown. I think they're going to take another run up at and kiss that trend line. We've gotten so close a couple occasions. This is it. This is what I've been sharing quite often, this NQ 2-hour candles, 6-month price history, 120-minute candles, meaning every candlestick is 2 hours of trading. And it's just a beautiful trend line. And again, we've come to it. And so the reason, I told you I closed everything out the longs today, is because we're close enough, and with all that overhead supply, you're going to have a lot of trap longs that want to get out, and it's almost too easy to have a perfect tag of that. All eyes are on it. One of two things is going to happen. You're either going to pop right through it, or you're going to reverse shy of it. That's what happens when too many people, in my opinion, watch the same level. Now, with that being said, we already had a nice pullback today. They faded a big, what were we up, 2+%? I don't know. I can look in a second here. It might have been close to 3% on QQQ, and all that was faded on the reversal. We took out this trend line, but that, like I said, I suspect that's going to be a whipsaw false breakdown, and that'll give us a catalyst to pop through there if that's the case. Now, how do you trade that? So let's say I'm right. That's a big assumption. Sometimes it's the only guarantee I'll ever give you. Is many times I'll be wrong, so don't put too much into any one thing. I think it'll do this or that. But what you do know, what I can say is once you recover back above the trend line, then you have a false breakdown. That's where the shorts that have sold this will start to realize rut-row, that Scooby-Doo rut-row moment that, we shorted that breakdown. I thought we were going to drop, and we go back up. And then we've already hit this resistance zone several times right here. Again, this is the resistance zone we sold out on Wednesday. Expected to pull back then. Expected another, they'd buy it back up. They ran it again. And so now I think the odds are if we run up there again, we'll probably hit the trend line and probably even pop it and then take us higher. We'll see. Again, no, actually more. Again, look, guys, I'm getting 5 steps ahead. This is what I do as an active trader. Whipsaw here. If they run it up, pop it, and then go up and then back test. Probably not run all the way up to 20,093 without a back test of the trend line first. So probably if I trade it, I'll be most likely selling the initial pop and then maybe buying the back test of it there or around that level. So, and now look, if that doesn't happen, what I can tell you definitively is a breakdown's a breakdown, and unless it fails. So there's a breakdown. Again, I'm skeptical of it. I suspect it'll get bought up here and prove to be a whipsaw. But if we do go down, you can see that level there, or you can drill down to the shorter term charts I've been posting or your own and look for what I call micro levels. This is that 15-minute chart I've been posting as well. Oh no, this is the hourly. I'm just going to, since I'm here, I'll just cover it. There's the downtrend line. Again, close but no cigar yet. There's that minor uptrend line that we just broke. And you can see some kind of micro levels. We're at support right now. So this is a level I actually bought right before the video. That's why I wanted to start the video. There's a nice gap, little punch through it. I like that. And again, I suspect it's going to fail. So to me, it's pretty easy. Just take it, press it pretty hard, put a stop right below that recent low, which I'll get to QQQ in a second for you QQQ traders. And again, if you're a long-term trader, investor, don't worry about this micro analysis stuff. There's that 15-minute chart I've been sharing with you. So if you recall, and I give you the two, I usually do that. I'll show you at least the previous post chart so you can see, if and how things played out. We were right there. There was a pullback to back test the trend line where support, quote unquote, should hold. It did hold, and then they turned around, they popped it, so arrows out if it break. This was a symmetrical triangle from this downtrend line and this uptrend line from that point. That's where I gave it to you last week. So what I did, since we had that additional confirming reaction since that last chart I posted, the 15-minute chart last week, that gave an additional reaction. So now we have 1, 2, 3. In my book, it takes 3 to confirm because any 2 points can be connected random. So a trend line needs 3 distinct reactions to make it valid. And then we had another reaction there today, and then the breakdown of it. And again, we're still below it, but you can see this is support here, 18,714. So that's the one I bought at. If that breaks, then it's going to get pretty ugly. And no, I'm sorry. I don't think it's going to get too ugly right now. I think, remember what I said last week? I expected some noise for a while. The market's probably going to digest everything. I'm going to get to some of my comments regarding kind of the fundamentals of this whole thing, if you will, in 1 second. But so that's it. So to me, it's subjective, risk a little bit. They take it out and I'll get stopped out, and that's fine. I don't think I'll short it. I'll just take a little loss and move on. If they rally back up and they can get back above the trend line, we're probably going to go up. Remember that upper most trend line's a little bit higher there. And again, since we've already had several runs up here, they might just pop through there if they can get it. You can hear my voice. I'm not convinced, and more importantly, so here's what I'm doing, guys. I started out with the short-term charts, the kind of the nitty-gritty, thread the needle, active trader only stuff. Now let's go to the long-term charts for a second. Let's not forget the big picture. I'm going to click over to the weekly chart. This is the big picture. The big picture is we've had a mountain of evidence. My little check marks I do with the bearish engulfing weeklies. I pointed those out the week that happened, right Friday, right after the close. We had every, not just QQQ, every single important index, the Wilshire 5000, the S&P 500, the mid, smalls, just about everything had those bearish engulfings, which were potential topping sticks. And so that, for a long-term trader, those are still in play. And whether you decide to, micromanage, that's one thing I'll do with my long-term positions. So active trading account, in out, long, short, doesn't matter what the trend is. If I'm active trading, if that's there. And when the VIX is high and volatility is high, that's when I'm, I do so many trades in a day, easily sometimes a dozen or more NQ long and short. So that's why those are not all posted on the site. Plus it instantly, I may see something, all of a sudden, boom, got to jump on it. If I sit there and screenshot a chart and try to get notes out to you, because I've had this asked many times before. You just can't keep up. It's like trying to learn football and then getting, Patrick Mahomes says, yeah, I'm going to teach you everything I know. Let's get in the game. Stand behind me. When the ball's hiked, follow mirror my every move. And then you can't do that. Now, on practice, you can sit there, and someone can coach you how to, play football, but you can't sit there in the game. So there's no way to follow an active trader is what I'm trying to say. And that bears repeating because sometimes people want every single trade, and that's one account. So in the long-term account, I always make a point to tell you what the, where I see things going, how I'm doing it, how my positioning is going. And I'll get to that in a second. So a little more in detail, but right here, this is it. So you had the bearish engulfings, following the divergent high. This was all priced in. Then you had the break of this trading range here, which coincided with a break of that big uptrend line, big rising wedge. The 200's taken out, back tested. I mean, this is just it was one check mark after another. It played out almost too easy, really. However, now we're in the not so easy area now. Markets got extremely oversold, but I also talked on that. Remember, we had a lot of evidence, a lot of sell signals triggered, long-term stuff on the weekly charts. We still don't have my longest term indicators on the monthly flipping to bearish yet, nor can we until the end of this month, because on a monthly chart, I need to wait to see what happens at the end of the month. That's why I'm keeping things a little bit open. Again, this looks and smells a lot like an initial leg down in bear market. Could be a correction on the road to new highs. I am not writing that off. And again, I will trade and pivot accordingly. Just wanted to say that I certainly won't rule that out. I mean, of course, you can never rule it out. I'm not talking in possibilities. I always say anything's possible. I talk in probabilities. So there's still a decent probability, depending on what happens going forward. But with the technicals and, of course, the fundamentals, there's that possibility. So we'll see. All I can tell you definitively right now is to get there, there's again, I have it kind of busy board here, just a mountain. And this is what I gave you last week. This purple box was that my bounce target zone. That I do that a lot, on both downside. We did it with the VIX recently, our scale back in zone after the first target was hit. I'll get to that. Let me shade it up pretty good so you can see it. I think you can see it here. There's the shaded color. And so that was what I gave you last week. So anywhere from where we pretty much just hit the last Wednesday and again today, we're at the bottom of that, what I call, likely or probable bounce target zone, meaning this rally could stop today and that contains it, or it can, if it wants to go up there. If it does much more than that, there's probably something else going on. And then the odds of new highs in the market will be likely. Because if we take that out, we're going to have taken out both the 200 exponential, the red line, and the simple, which is at the highs. We'll have taken out the top of that flag there. And then just above that, we'll get back into the trading range there. So that would be, I should really have the box at the top of the range. I've talked about that. I could see the potential for a back test. But it's so obvious that I think that you'd see a lot of selling before we even got there. Now, I put a higher probability we stop around here real soon than we go up there, okay? I just want to say that. So if we get up there, and let's say on my long-term accounts, I have dry powder, that's where I'll deploy the final lot of it. And then I won't be adding is if we start getting into the zone. I won't stop out right away. But if we start to get into that zone, I will start scaling out of long positions. Again, if we happen to get there. Again, I don't think we're going to get there. I think what's going to happen is, I've talked about this many, many times in the past. To profit from a bear market or correction, to be a short seller, you've got to be Johnny on. Your timing has to be spot on. You cannot stay too late to the party. In a bull trend, a bull market, you can have the worst market timing skills. You can be buying all the highs instead of buying the pullbacks and the lows, and it's just going to keep bailing you out. In a bear market, you've got to, because the short covering rallies are explosive. If last Wednesday didn't teach you that, or any of the other days recently, I'm sure you're aware of that. I've been talking about it. So again, you got to look at everything, and it's what I do day in, day out. I quantify RR. Before you hit the bottom, I start saying the RR to adding shorts or staying short is no longer favorable. I address the fact that sure, the system can break. We're at key support on the financials, on the stock market. But I said probability-wise, it most likely won't break. In fact, here, let me just expand on this reply that I made down here to David K. Wondering if you're going to put out some static charts or short video over the weekend about the electronics and chips being excluded from the tariffs. See, I think with the bear market or the stock market, fast-moving market, especially if you're going to short, it's like a chess game. You can't be playing checkers in this market. You have to be playing chess. You have to be looking 3-4 moves ahead. Before the Trump put the moratorium, the pause on the tariffs, I predicted that it would come out. We'd get a tweet because it's the powers that be. They're not going to let the whole global financial system crash. It took it down. It took it to the red line, but to me, the odds were very high that was going to come in, or you get a Fed emergency rate cut, or both. And we didn't, and so we didn't get the rate cut. Again, that was the lower probability. We got the pause on the tariffs. Everyone knows. I mean, this is scripted out. Trump said he was going to do this all along. You know him from the first term. He'll at least try, just like he was going to build a wall. But did he build a wall? No. He tried to build a wall. With the tariffs, it's the negotiating tactic. So you knew that would come out, and it did. And then the market exploded higher when the pause went on. And then I also addressed on several occasions over the last week or two about Apple. Apple is the pinnacle of U.S. success technology. We are the world's leader of, technological advances and innovation, and it is literally the poster child. It was our first $3 trillion company. So Apple is, the creme de la creme of America technology. And I don't, Trump may, may or may not align with Tim Cook's, ideology or politics, but they're not going to. They wouldn't let Apple, because if they let Apple die, and Apple can't all of a sudden just immediately shift all production, as much as they do from China outside of China. That doesn't happen overnight. Everyone knows that. So again, I predicted that would also, there would be an exemption. They were already petitioning for it. To me, it was almost as close to 100% that you would get an exemption from the tariffs from Apple. So again, my point was, and again, it was said in advance that was priced in. So now here's the reply I made. Sure, unarguably, it's positive for the markets, especially Apple and other top-weighted components will be absolutely beneficiaries of that, of the pass on electronics and some chip makers. So to me, that headline decision by the White House was a near 100% certainty, as I've spoken about in recent videos. And what I just said, Apple's a poster child of U.S. dominance in technology and innovation. And as such, I completely expected that. And I'm sure many professional fund managers did. Just as I predicted, we'd get that abatement on the policies and tariffs. Hence, the reason I was long and bullish before the headlines hit. So basically, how much of the 16% rally off the lows has the NASDAQ 100 already priced into this? In other words, the reason I sold today, for big part, technicals first, the levels, we're back to those significant resistance levels at bounce target zone. And the headline that made the futures rally last night, this thing broke on, what was a Saturday, I think we got it. Knew the futures would be up. We knew the market would gap up today on it because the masses now buy it. It's called buy the, in this case, buy the rumor, sell the news. Exactly what I was trying to say. And so that's what today was. That was a clear textbook, buy the rumor, sell the news. Again, it should not have been a surprise to anybody that Apple got a pass, and as did a lot of big tech companies, because you kill tech, you kill the U.S. market, right? It doesn't matter. Every single utility company right now could blow up and burn to the ground in the utility sector, which is one of the 11 sectors of the S&P 500 would go to zero. But guess what happened? The S&P and the NASDAQ 100 wouldn't move. Doesn't have utilities in there. Hardly any, if any at all. And even in the S&P 500, the utilities is like 2% of the index. Technology is over 25% of the index. So again, it's all about tech. You can't kill these tech companies without killing the market. So you knew they were going to get a lifeline. And again, now there's a lot of uncertainty. So now I'm going to sit here and tell you what's already happened. Now, what I think is going to happen going forward. I've talked about this before. I believe the damage is done. I believe the damage was done before the market even peaked. I use the analogy of either a hunter that makes that shot on a deer, and it's not a clean shot. And I don't mean to be graphic, but if you guys hunter, the hunter misses, and it's a gut shot or whatever, and they got to follow the blood trail, and ultimately the deer, it's going to run away, might go 100 yards or whatever, but it's going to die. The damage is done. That bullet did a lot of internal damage. Or sometimes people are shot, they go to the ER, they might even feel okay at the time, and they end up dying on the OR table because of internal injuries, internal bleeding. So sometimes you're shot in the heart, you die right away, and sometimes you've taken a fatal shot. So I do believe that the stock market and the economy have been dealt a fatal blow. I think it happened in other things before this, and the tariffs were just the catalyst. The charts first. Remember, we were on sell signals and short long before the tariffs were announced, long before liquidation day, or whatever you called it, liberation day, was announced. But anyway, so that's where we're at. Again, this market, is going to react on news, but you also have to think of how much of that news has been priced in. Now, where I think things go at this point in time, let me find a clean board. Let me pick on something here that doesn't have a lot of markups on them. Just go to, I'll turn off all the lines. I'm just looking for a black background to draw on. Okay, now I think the market will turn its focus to the economy more, the economic indicators. I've covered this ad nauseum. If I go through here now, it'll take forever if I go to the charts. I've covered the national unemployment rate, which has already turned the corner. And I went back as long as you can go back in history, decades, showing that, the same reasons that 99.9% of economists were bullish and calling for zero recession or very low, if any, chance of recession in 2025 as we were heading into the year at the end of 2024. Yet I was saying the other way is they were saying that's bullish, record low employment. And I showed you the chart many times over that when you fall down to this range about where we're at the low end, you don't go to zero, you go down to about 2, 3, 4%. And that never in history have you stayed there for any extended period of time. In fact, it's always been a V bottom. So my logic was so contrary, but so simple. You just look at the chart, and that's when you get down to those levels, there's nowhere to go but the other direction. And again, history shows if best case scenario, maybe you stay there, record low unemployment or near historic low unemployment for years or a year or two. But that just has never happened. So that was one thing there. Everything else has been priced in. And I can't say that it's an immutable outlook, that it cannot be changed. I think the odds are so low, and so therefore, I think you'll start to see this. And what about the wealth effect? I mean, we know that, and I said that if nothing else, the drop in the stock market, which was priced in and projected last year, once we got the sell signals and the levels broke, which right here again, go back to the daily chart, or this is the daily chart there, sell signal, 200 days, sell signal, back rejection, that all this would then crush what is, I think, probably more so than any point. I'm just kind of guessing. This isn't my area of expertise, but I'm going to say that the stock market wealth, as far as consumer confidence and consumer spending and the amount of people's money in the stock market, is probably the closest parallel is probably 1929, the Roaring Twenties. And so when you have this massive drop, and I know this just from talking to people, both personal people I know personally, listen to TV, talking to other people, everybody just got in this mindset that the stock market was going to continue to go up forever. AI was going to change the world. And all you had to do is overload up. And it's not even and people don't even have diversified portfolios anymore. That's why I'm so confident that this drop is in the names that everybody was chock full of. NVIDIA and Apple and Amazon and Microsoft, the big tech stocks, Meta and the likes. And because of that, don't underestimate the power of the drop in the wealth effect. I don't know if any of you picked up in the article over the weekend, the Wall Street Journal, which is given how many high-end deals. They say the high-end real estate market, that's defined as, I think, the top 5%. I forget the number of homes priced at the upper end of the range. The multi-million-dollar homes, how many deals fell apart just in the last couple of weeks. We're talking anywhere from $1-2 million properties they cited in there to tens million, properties worth tens of millions of dollars, where the buyers backed out. And they clearly cited either they're directly said my portfolio's down, way down, and and this just goes to show. And to me, I feel like you hear this and you hear these stories and everyone's screaming and yelling at Trump for doing this. And look, I know not everybody has a background in what I do as a former financial advisor, but I have to hold my words, my tongue, and be very careful. But it's beyond complacent and arrogant to have, if you're let's say closing on a home, and you have to come up with a down payment of $200,000, whatever. And that $200,000, instead of sitting in a money market, was sitting in your stock portfolio to the last minute. You're going to wait, and so that's the cause where people are backing out, because in some cases they cited the money that they had for their down payment. They've lost 20-30% in their stock portfolio. Whatever happened to prudent risk taking and long-term planning? In other words, if you have gold pockets of money. If you're buying a house or your kids are going to college, if your kids are 2 or 3, yeah, that money can be in the stock market. If your kids are 16, 17, 18, about to graduate high school, that money should be in all cash at that point. In other words, it's simple. It's the old, hey, take the number 100. This is what we did as a rough rule of thumb back when I was a financial advisor, and it hasn't changed much. Take the number 100 minus your age, and roughly that's how much you should have in the stock market. So if you're young and you're in your 20s, you can have most, if not all, your money in the stock market because you have a very long time horizon. If you are 65 years old and about to retire, you should have, by that old rule, no more than 35% of your money in the stock market, because you don't have the opportunity, you don't have the earnings anymore to add to your 401k, nor the time horizon to ride out a bear market. And somebody asked me to expand on what I've been saying, how I think this one will be a lot different from others. And in a nutshell, just please Google search the term Japan's lost decade and look at the performance of the Nikkei. It was really 2 decades where the Nikkei was in a super long secular bear market. And it took over 2 decades to get back from where it was when it peaked, with very similar circumstances fundamentally and technically, really, back in the early 90s. So look at that. And again, I think that's what we're heading into. And I think a lot of people will be trying to use the playbook of the bear markets in recent history. Remember, COVID was an atypical one. It's what I nicknamed Ursa Interruptus, a bear market that was interrupted by the Fed and all central banks with hitting the nuclear button. There was no other term I can use for it. The amount of stimulus was unprecedented and never before seen. And so if you blinked, you missed it. But then you go back in time and you see these were the last 2 real bear markets. And they went for about a year and a half, less than 2 years. There's the dot-com bubble. This is the NASDAQ. You can look at the S&P 500 as well if you want. And you can see these were what most people are probably expecting, even those that have maybe conceded at this point. Yeah, we might see a bear market. We might see a recession. But it'll be over, in a year and a half. But again, I expect... And one of the reasons, other than me just pulling out the Japan Nikkei index analogy, and this is, again, I'm just being repetitive. If you followed me for a while, you've known this, but somebody asked me to expand on why I say that. It has as much, if not everything, to do with this. The bull market that we've come through, for those of you that have been investing or just aware of what's gone on for decades now, has everything to do with the chart, interest rates. And if you're old enough to remember, you've studied it in history, we had runaway inflation back in the 70s, and that peaked in the early 80s. And from there, so we had a secular rise in interest rates, secular bull market that peaked. And then since then, we've had a very steady secular bear market in interest rates, falling rates, which was very bullish and was the backdrop for the strongest bull market, bull run in history. And so that's so ingrained in everybody's head that buy stocks, you'll get bailed out. Yeah, there's going to be corrections along the way, but if you just hold on, within a year and a half, the bottom, or within 2 years, the bottom is going to be in, you'll be off to the races. Maybe that'll be the case. I don't know. I don't think so, because by every metric that I've covered here, and predicted that would be the end. That was the end marked. And you can look clearly by every metric so far, higher highs, higher lows, the downtrend line taken out. That shows that secular declining rate, falling interest rates is over. And we're seeing it now. We're seeing this is, despite Fed rate cuts, they're not working anymore because the federal deficit is out of control. Inflation is now here, and the Fed is in a very similar, in fact, the only other time we've had something similar was back here, where they are now boxed into a corner and cannot do what they did. And they did it nilly-willy back here. This is why we're in for such a long amount of pain for such a long period of time. They kept the pedal to the metal for too long. They had plenty of opportunities to normalize, bring rates back to normal levels, 5-6%. 4, 5, 6, but they decided every time the market would hiccup, they'd hit it with quantitative easing. They'd bring, if the rates weren't already at zero, the one time they tried to walk it back in 2018, they put it back to zero, and they kept rates artificially low for too long. And again, so that's why I think I use that analogy. I think the damage has been done that is, in my opinion, irrevocable at this point. And so now, the takeaway, I'm not trying to be Dr. Doom and Gloom. I'm not going to sit here and put everything I have in short and then sail around the world for 2 years and come back and cash out. It's going to be a trader's market. I truly believe it has been so far. And so I welcome it. And I can only, I kind of roughly see how it might unfold in my head going forward. But, the roadmap's there. But we use it mainly intraday charts, 60-minute daily, weekly to kind of navigate that and decide when to be long, when to be short, and then also when to stand aside when my confidence is not high. That's what I've learned over the years. You guys remember the movie or the play? Well, the play and then the movie Glengarry Glen Ross. They're actually running on Broadway again now. There's that famous scene in there in the movie, which they took out of the play. A lot of people are upset, where Alec Baldwin comes in and does his little speech. And in there is ABC, always be closing, right? That's the famous line from there. It's a great movie. If you got any of you who've been in the life of sales before, it'll ring hard. You've probably seen it. But always be closing is what the sales manager said to his sales folks in that meeting. To me, there's a lot of people that have the mindset always be trading. And I used to have it. It's called traderitis. It's a hard bug to shake. But over the years, I've learned when to sit on my hands, and you should not be always trading. It's important when the charts are not clear, when your confidence isn't high, when the charts say we can break this way or that way. That's a great time to cash out if you've had a good run or if you've been getting beat up. It does, especially if you've been getting beat up. Professional traders have if they work on a trading desk, their manager who's overseeing them will put them on a cool down period. If they're on a losing draw or big loss or whatever, and they have those the kind of timeouts, if you will. And when you do this for yourself, like I do, you have to learn when to put yourself in timeout. And what I've been trying to do over the years is kind of anticipate ahead of time before I start giving back profits. So that's what, to me, like I said, what today was all about. After a big run, we're coming up to that level. I could see the potential this market may want to break out. The news has flowed. We've got the pretty good pause on the tariffs now. News seems to be running the right direction. And so I suspect they're going to run this market up, probably pop that. But I also wouldn't be surprised in the least either if we've seen it. If we've seen the highs last Wednesday and about, again today, and we had the next leg down. And so because I have that kind of dichotomy of views right now, what am I going to do? Flip a coin? I'm talking long-term again, guys. I'm back to long-term account. So no, I'm going to sit back. And even in the trading account today, I already told you trading account what I did, and then I went back in today. So that's it. Told you I'd look for day trading ops. It'll be my third trade of the day, I think. Short-term stuff. But this is, again, the bigger picture. This is QQQ weekly chart. And when I look at this tells me this appears like an initial leg down. It doesn't look like something a one and done thing. Possible, but not probable. Right now, not the most probable opinion or outlook that we go to new highs. And if not, again, it's very simple. I haven't changed it since last week. Where do we go? Well, anywhere from where we already hit last week, and again today, we're at the bottom of that bounce target zone, maybe up there. It's, objective level to scale in up to, but not above it, not above that. If you start getting back above 500 on QQQ, you're back into this spacing pattern. And at that point, you should be, in my opinion, more concerned with either stopping out. Again, I don't know if I'll put, can't tell you today if we get there, if I'll be flipping to long. And I'm talking long-term positions, but this is my preferred scenario, and that hasn't changed. Back up here, and then boom, next leg down. Where to? Same targets I've been maintaining since last year. Board 8. It's my weekly targets, which really are continued with targets laid out last year and have not been modified. T1 and 2 were hit. All the reasons back then on August 5th at the lows. Hard reversal, I called it. Cover all shorts in all accounts. Even the long-term accounts go hard long because there was too much evidence not to. Again, covered back at the time. I don't want to loop back. It'll take forever to get that. And then just recently, as I covered, we hit T3 with a little momentum fueled overshoot intra-week. This is a weekly chart, only to close back above that level there. And here we are today, right there. So this is just the typical reaction off the initial tag of a target, just like the initial tag at T2 resulted in a pretty powerful reaction there that took us to a marginal new high, T3 reaction. But if we're in a bear market, and where we're at, I think it'll probably be relatively short-lived. And I think we could get down here pretty quickly too. I think once the reality sets in, that I use that analogy from Saving Private Ryan, that beach, scene on Normandy, storming the beach, where the guy gets a bullet hits the helmet and ricochets. A soldier, he takes his helmet off. Guy next to him go, man, you lucky son of a bitch. Basically dodged a bullet, and then the next one got him in the forehead. So I think that's what the market will do here, where they'll think, okay, good. Tariffs, we don't have to worry about it. Trump's come to his senses, and he's starting to make deals. Other countries are making deals, and then the focus will turn to the economy, because this has already done, in my opinion, irreparable damage psychologically, and actual portfolio losses that are going to then translate into decreased consumer spending. And let's not even get started, but it's worth mentioning. I keep talking about the consumer and the impact that a drop, the 20-something% drop. Again, forget about the S&P. Most people have been top heavy in the NASDAQ 100, so they're 25% on average down, roughly on the index. Of course, if you have the high-flying names, you're down even more than that, right? So that's that. And yes, consumer spending is 2/3 of GDP, but that other, third, is made up of private sector and public sector, public spending. Public spending, they're kind of curtailed right now because we have these massive budget deficits. It's really starting to become a thing. There's talk now about the dollar. Dollar's been sliding. So you can't do what we've done for so many years now, so many decades, where they just keep spending in Washington. You finally have a lot of pushback there. And more importantly, the market's speaking loudly. The bond vigilantes are showing up right now, checking the Treasury and the U.S. dollar and the U.S. government, what they can do. The dollar's sliding, so that's going to contain that. Then let's talk about the private sector and the economy, because obviously you guys know what I did. I shifted away from technicals, meaning charts, to fundamentals. I've said this many times. The stock market, you have your own opinion, everybody does, but the stock market doesn't give two flips whether there's a Republican or Democrat in office. It just likes certainty. The stock market, businesses hate uncertainty. They cannot plan. Big companies can't change on a dime. They can't change their hiring and their CapEx plans and all that. That stuff takes a while. There's meetings and quarterly meetings and board approvals. These things take a while. So when you have a very uncertain, and we have an extreme, I don't think we've had such an extreme, uncertain macro environment, the economic environment, in my lifetime, since I can remember. This is almost unprecedented. So the impact you're going to see here, it happen? It's already happening right now under the hood, but corporations will be throttling back. They're going to cut back on their hiring. They're going to start. Some will be laying off. That'll be an increasing and exponentially increasing thing, by the way. When the job market turns, again, it's usually starts to pick up steam as you start to see the layoffs. And so that is the next chapter that I'm looking ahead to. And the market is a very fast discounting mechanism. And it was always the stock market, they say, looks out 6 to 9 months ahead. So if I am right, yeah, we could have started the next leg down today. Very, very possible. Wouldn't surprise me in the least. So right now I'm kind of open to that. Take it day by day, minute by minute. The way it works is each support level has to be broken. And, let's see what happens today. I'll end the video where I started it. There's the breakdown. So far, not a lot of impulsive follow through. There's, if you look at QQQ on this 60-minute chart, we could go down here to 450.50 right there. That's a big old gap right there. That's a support line I have. If that's taken out, this is the next support level on the 60-minute chart. That's about 443 on QQQ. And if that happens, it's going to start, you're going to have a lot of worry come back into the market. You're going to have, more margin call selling. That's what led to the, powerful and relentless drop here recently. But again, I think that comes, but I think we'll probably push this up a little higher. And, if we break the trend line, I will give you my thoughts then. If it happened, if I don't do another video before that happens, I'm just telling you, I most likely will. Again, that's what I think it'll rally up. If you look at this 60-minute chart, where to? Traders will be looking at this gap right here. See this big old gap? Top of that gap's at 472.50-ish right there. So that would be a likely area to see some profit taking come in right after the breakout. And unless they're just buying the crap out of it, maybe there's some fundamental news they could blow through it. Again, I'm just looking at one time frame here. I'll be looking at 5-minute charts, 15-minute charts, daily, and I'll be looking at all of these guys right here too. Apple, remember, Apple came off this big divergent low. Again, I already commented on Apple, the news today. To me, I would have been surprised if we didn't get the exemption on Apple and the big companies like that. So again, it was, and there's a good example. It was a buy the rumor, sell the news, and that's just the initial bout of profit taking. Apple still, look at that. It's still a good buy right here. It's coming back to support. This is another reason why I think we'll buy it up here. 199.86, called about 200. Really nice support right there. Uptrend line support, price support. And Apple, this is a stock. Everybody loves Apple. And I said this just a week or two ago. I said, for the life of me, I can't understand. If you liked Apple up here, you liked it here, how do you not love it when it's down? The world's largest company, down 35%, 1/3 of the entire market cap. How do you not come in and like Apple or the market there? So beat down. And again, from a technical perspective, 60-minute chart, you had that nice divergent low last week. We're rallying. And just like the market, there's a downtrend line overhead that I'd be surprised if it didn't get checked. So there's the upside. If Apple hits that trend line, it's going to have to rally about another 6.8%, give or take, from where we're at right now. So that's going to most likely put upward pressure on the market if that's the case. Now, if it doesn't, this is support, about 199.86. Next support, it's not great support, but there's a little bit right there. But again, this is where they should come in and buy. And if you want to buy Apple, I think it's objective from where we're at right now, about 203, all the way down to, but not below, not much below. I wouldn't buy below there. I'd wait for a recovery back above 199.86, and I'd be more concerned about having a stop below there just in case this is it, because I made the case that we may have done. We already hit my preferred and bounce target zone, bounce target area in the Qs and in the market. So if they start selling the overall market, Apple's going to get dragged down with it, ultimately. Okay, long video, so I'll stop it here. I already made mention today, some of the other things I like. I still really like that orange juice future. I think we're up almost 10% today. The market's probably closed now on it. They have quirky hours. They open at 8 a.m. and start trading, and but that's coming off that big divergent low and very oversold. And the grains, I still like wheat. I'll do those in a separate video. And I shared my comments. Somebody asked on gold and GDX and everything else. Remember, it's all about the dollar. US dollars at support, but it's been getting beat up lately. That will certainly have an impact on gold and silver. Treasuries, if you look at the comments, I've answered most of these. Treasuries, I think I updated. Gold, everything else, grains, and treasury. Yeah, well, I already covered treasuries. I just said that. I'm trying to think what else there was recently. I can think that's about it. All right, let me wrap the video up here, and I'll either get another one out today, or if I see anything that stands out, I'll get it out to you. Otherwise, I'll probably might even wrap up early today and just take the rest of the day off. This has been Randy Finney with the Right Side of the Chart.